Hey there, welcome back. So in this section, we're going to be talking about our methodology, the basic economics and momentum that we are going to use to identify and get in on profitable trading opportunities. Now, at Momentum Options, we trade momentum using options. Pretty simple. Momentum trading is a strategy used in financial markets based on the idea of capitalizing on existing trends of a security. So it involves buying assets that have been rising and selling those assets that are falling under the assumption that these trends will continue for some time. So why do we assume that price will continue in that direction? And the short answer is it's physics. And we really stack physics in our favor with our momentum-based strategy by using multi-time frame analysis, by using many different indicators and studies to make sure that we have confluence in whatever we're looking at. And we use many different methods in the way that we find trades to ensure that these are high probability continuations. But why does physics say, when price is continuing, it's going to, or when price is moving in one direction, it's likely to continue? Well, Newton's first law of motion says that an object that's in motion is going to remain in motion unless acted upon by an equal and opposite force. So if we think about a car, if a car is in park, sitting still on a flat surface, then it's going to sit there still on a flat surface, right? Not unless you turn it on, you put the gas down. But also keep in mind that a car on the highway going 80 miles an hour, you let off the gas, you're still going 80 miles an hour. Maybe you slow down, you're going 75, then you're 70, but you'll keep rolling a good little ways. Until you hit that brake, your car is going to roll. Price action is no different. Price that's not moving doesn't move. And price that begins moving tends to want to keep moving. So when we look at, say, the S&P 500, this is the SPX, the index of the S&P from 1930 all the way up to 1978, okay? Now, I've mentioned earlier, when we talk about the market, we say that over time, the markets tend to continue higher. And from 1930 to 1978, you can see what I mean. Price kept kind of going up. It definitely had years where it didn't do so well and went down, but you can see that price tends to want to rise. Now here we had the end of the gold standard. Prices kind of took off when that happened, kind of hyperinflation area. And then we had stagflation, the gas shortage in 1970, the whole global slowdown and recession. And then things started going kind of back up, but then back down. And then all of that looks like nothing. Because from 1978 on, we had the rise in technology and computing, telecommunications advancements, connections around the world. Everybody started being connected. We had globalization. We had dot-com stocks. This is when Apple and Microsoft first, really popped up out of nowhere. IBM popped up out of nowhere, and the market just took off. So this was that time when it kind of looked crappy towards the end of that chart, didn't it? But markets continue. Momentum tends to want to continue. And that's what I'm trying to show in this chart here. Towards the end of that, we had the dot-com bubble burst. Horrible, horrible crash. And don't forget, everybody wants to tell you about how bad 2008 was. I mean, it was. I'm not discrediting that. But look where we are now. Because momentum tends to want to continue. And all you need to do is be able to recognize when it's starting to happen. When you are able to recognize when it's starting to happen, you can get in on it, hold on for the ride, lock in profit, as price continues, and then do it all over again. So the second law of motion is that the speed at which something is traveling is directly correlated to the amount of force that is behind it. So what's going faster downhill, a car that's in drive or a car that's in park? And that's a pretty obvious question, right? If a car's in drive and you're going downhill, it might even pick up speed. If you got your car in park, I mean, If it's a really steep hill, you might slide down. But other than that, not much movement, right? Now, the same is true for the stock market or any stock or any ETF. A stock that's moving across time frames is obviously moving faster than a stock that is going down on one time frame, up on another, down on another, instead of being up on all of them. And we're just looking at the market over those last, almost 100 years. You can clearly see on a long-term scale that the momentum is pushing price higher. And as you go down, so we're looking at, we go back, these are all monthly charts, monthly candles. So each one of these candles represents one whole month in time. Each one of these dotted separations is 1 year. This is one whole year right here. So on a monthly scale, we can see that price is trending higher. And if we go down to, say, weekly candles and then to daily candles, we might see that that same momentum or price is not only was it going up on monthly candles, say through here, but the weekly ones and the daily ones, and maybe even the 4 hour and the 1 hour. So when you start going down through all of the different time frames and you see they're all pointed in the same direction. And we have a bunch of different studies and indicators that we'll use to help us quickly determine that. But when you see them all moving in the same direction like that, it tends to want to move a whole lot faster than, let's say, that time in the market right through here where it was moving down. But on a whole long-term scale, it was moving up. So we had down on one time frame, up on another, which causes a little bit more of this choppy kind of action, this down, then up, and then down, and then up. But the second everything starts to get back into that up motion, breaks above previous levels that, previous highs, above resistance levels here, now we start having momentum that's continuing on multiple time frames. Just kind of picturing it in your head for now. So if you had to guess, just take a look at these two different charts. And I did just kind of pull up two kind of random stocks I knew were performing differently. I don't really trade either of these, but P&G has been on my watch list for more than a year. And it's been up for that whole time, or heading up about that whole time on my weekly watch list. So my weekly watch list I shared, these are stocks that I'm looking to add to my personal watch list. I might want to invest in. You might want to invest in. But yeah, this one has been popping up on my scans. It's been meeting all the criteria for a good long-term investment for a little more than a year. And for a little more than a year, it's been going up. So if you had to guess, and this stock over here is just one I had to pull up because I was thinking what stocks are pretty big names that haven't populated on my list in that whole time frame, and GM was one. So if you had to guess, this is the all-time high. Here's our 52-week high is up here. Which of these two stocks, if you had to guess, will reach that purple line first? You think it's going to be P&G or GM? Excuse me. Obviously, P&G, because it's closer, so it looks like it'll get there first. That's simple. Obviously, it's moving in the right direction. It's going up versus this other one that's kind of going sideways down. So yeah, why not GM? Because, well, it's got a lot further to go, and price is moving in the wrong direction. But if you just think about it, for example, 156 targeting 165, 35 targeting 95. I mean, if this hits its all-time high first, it would be significantly more profitable. But creating a trading plan, targeting this number, looking at this stock, seems a whole lot easier. Understanding how long it might take to get there, a whole lot easier. Also keep in mind, you buy down here and price goes up to almost $70. That would be double your money, keep in mind. And if you're targeting this number still, I mean, you got a long way to go. This would be a great place to take profit. So just the time frame of getting there, you might hit resistance, come back down, get scared out of your trade before it continues on later on. because this is a resistance level that was established, looks like in 2022. So just by looking at these, it's kind of obvious that P&G looks like it'll get there more quickly. The ability to make a trading plan for that also looks much, much easier. So let's take a look even more closely. So here's GM on the monthly chart. Very kind of choppy, up and down, up and down, up and down. Had a big year up and then back down. And now we're just kind of grinding down at the bottom. Look on the weekly. Well, it tried to hold a trend here, that trend broke. It tried to hold a trend through here, but that trend broke. Now it's trying to find some support through here. It is breaking this downtrend, but it could be starting a new one. Also, there's been no closes below this number since 2012. It broke below, but kept retaking that level. Now we look at P&G. Well, that looks a whole lot better. It's holding this uptrend. It's respecting the long-term trend. If we look on the weekly, oh, look at that. It's breaking out of this downtrend. So we're respecting and holding a long-term uptrend, and we're starting to break out on a weekly time frame. Matter of fact, since I took this picture, P&G has made new 52-week highs. So this stock is even higher. Now it's starting a new uptrend on the weekly, going up on the monthly, going up on the weekly. Where would you put your money? Which one's getting to all-time high first? So the third law of motion is going to be that when one body exerts force on another, the second body is going to exert an equal and opposite force. When it comes to market, this means that for every buyer in the market, there is a seller. Every time you buy something, somebody sold it to you. Every time you sell something, somebody bought it from you. So there's a bid price and an ask price, and they represent the buyer and the seller, and they're always there on everything. Everything has a bid and ask. That's the market maker's job. So the third law of motion simply says that it's impossible for you to place a trade without there being another party on the other end to make it happen. Okay. Now, when we think about the market, we should also be thinking a little bit about supply and demand. So supply refers to the quantity of a good or service that is available for purchase at a particular price. It's the amount that producers are willing and able to sell. So the law of supply generally says that as the price of a good or service increases, that the supply also increases. The number of people ready and willing to sell at higher prices is greater than lower prices. We look at a chart, we can see that. When SPY is high, there are more people up here ready and willing to sell. And when price is low, there are more people down here that are ready and willing to buy. Less people ready and willing to sell, right? So that's where demand comes in. So the demand of a good reflects the consumer's desire to buy, backed by their ability to buy. So typically there's an inverse relationship between the price of a good and the quantity of a quantity demanded, excuse me. So when demand is low, prices fall. When demand is high, prices rise. So another way to think about it, this is that area of low supply that I was just showing. And as there's fewer people ready and willing to sell, more people are starting to buy, demand is increasing, hits an area of resistance, demand continues to increase, breaking above that resistance. There are now buyers buying at prices they previously would not have, and price continues higher until it runs out of demand. Now we're at an area of lower demand, an area of higher supply. So when demand is less than supply, prices fall. And when demand is greater than supply, prices rise. This is the law of supply and demand. Now, a couple key points I want to make about this section. First, like I said, momentum tends to want to continue. That's that first law of motion. Second, the rate at which price travels directly correlates to the strength of the trend. And we determine the strength using multiple time frames. We look at the market over periods of time. So we might look at it on a monthly scale, on a weekly scale, on a daily, working our way down those time frames. The lower the time frame you go, and you get in on a trend from multiple higher time frames that are moving in the same direction, the more likely that trade you're in on a lower time frame will eventually work out in your favor, because that's simply the direction price is traveling across many higher time frames. So if you get in on a lower time frame, over time, the trade will likely work out in your favor. That's why we want to really stack the strength of the trend across multiple time frames to get in on trades that are likely to move in our direction. Okay? And another point, every transaction has an equal and opposite transaction. And then it's our supply and demand points here. When the price of an asset is high, the asset is said to have greater supply available for sale and a lower purchasing demand, therefore it tends to fall. And then the opposite is said to be true. When prices are low, the asset is said to have greater demand and a lower supply, therefore prices tend to rise. Okay, so that's everything for this methodology, the idea of how we're going to be thinking about price moving throughout this course. So yeah, in the next section, we're going to talk about exactly when and why we trade, what we're looking for, and yeah. So I will see you in that video. We're going to start breaking things down a little bit more, and then we're going to get into some basic technical analysis. All right, I'll see you there.